Welcome to the Deep Dive. Today, we're tackling a really unusual one, the 1-800-Flowers earnings call. That's ticker FLWS. They reported pre-market October 30th. And normally, a company misses top and bottom line estimates, the stock gets hammered. But here, a completely different story, a really divergent market reaction. Fascinating stuff.
It really is. That reaction is exactly what we need to unpack. You've got this pretty massive headline miss, right? But then it crashes straight into this very aggressive, very detailed, long-term restructuring story from management. So our job today is basically to make sense of that collision for you. Why did the traders freak out initially on the numbers, but then by the end of the day, they seem to completely buy into the turnaround plan, so much so the stock actually finished up?
Yeah, finished higher. It suggests expectations were just rock bottom, maybe, and the plan must have sounded incredibly convincing.
That's the working theory. So let's dive right in.
Okay, let's start with the numbers that caused that first wave of panic pre-market. The GAAP EPS, it missed badly, came in at a loss of 83 cents.
Yeah, minus $2.83. Consensus was looking for something closer to minus $2.59. So a significant miss there.
And revenue wasn't great either, $215.2 million. That also missed what analysts were expecting, and it was down sharply, like 11.1% year over year.
Mm-hmm. Those aren't just, slightly soft numbers. That points to some real pressure on demand. Unambiguously weak results.
And the market saw that initially. The stock dropped, about 10% pre-market?
It did. Responded exactly how you'd think. But the reversal, that's the crazy part. It didn't just climb back. It finished the regular session up around 3.7%.
Okay, up 3.7% after being down 10%. That's a huge swing.
It is. And here's the key part. The volume. Trading volume was 3 times higher than normal. We're talking 3.31 million shares traded versus the usual average of maybe a million.
Whoa, triple the volume.
Right. And that tells you something important. This wasn't just, shorts covering positions or passive index funds buying. This was active money, strategic capital, looking at those, frankly, terrible Q1 numbers and deciding, okay, the future plan here outweighs this current mess.
That level of volatility, that kind of conviction buy on bad news.
Right.
That's what we need to break down. It really suggests investors are betting purely on the future potential, not the current reality.
Exactly. But before we get to the shiny turnaround story, we need to really understand the hole they're in financially. These pressure points are serious.
Yeah, let's dig into that. It's not just about revenue declining. There's some real structural margin damage happening too, right?
Absolutely. Cost control seems to be a major issue. Look at the gross margin. It contracted by 240 basis points compared to last year. Fell to 35.7%.
240 basis points.
Yeah. When your sales volume is already weak and then your margin percentage shrinks that much, that tells you you're getting squeezed by pricing pressure or cost inflation, or probably both. And that puts pressure on everything down the line.
And you see that squeeze hitting the bottom line too.
Definitely. The adjusted EBITDA loss got worse. It went from about minus $27.9 million last year to minus $32.9 million this year.
Okay, deeper into the red on EBITDA.
And if you look at where the pain is really concentrated, it's in their main gifting segments, which suggests, some fundamental operational challenges need fixing.
So where specifically? Which segments are dragging things down the most? Because that tells us where the fixes really need to happen.
Well, the biggest worry has got to be the core segments. Consumer Floral and Gifts, that division saw the sharpest drop, down 14.6% to $115.4 million.
Wow, down almost 15%. That's the heart of their business, isn't it? The flowers, the traditional stuff.
That's exactly right. When your flagship category declines that steeply, it suggests you might be losing market share or having real trouble keeping customers coming back.
Or both.
And for a company that relies so heavily on those big seasonal holidays, Valentine's, Mother's Day, that kind of drop in core floral, it makes it seem like maybe the market thinks they can't even get the basics right anymore. That's how deep the hole is.
Precisely. And it wasn't just floral. Gourmet foods and gift baskets also slipped, down 8.6% to $76.8 million.
Okay, so weakness across the board in gifting. Yeah. Now, management did try to offer some explanations. They pointed to, external stuff like higher tariffs, transportation costs being up.
The usual suspects.
Kind of. They also mentioned a timing shift, saying some wholesale orders got pushed from Q1 into Q2. Okay, maybe that helps explain a tiny bit of the top line dip, but it doesn't really address the margin shrinking or that big drop in consumer floral.
Right. The structural issues seem deeper than just timing.
Exactly. The problems look pretty fundamental and need some serious intervention.
Okay, and this is where the story flips, right? Because the Q1 failure almost perfectly set the stage for management to roll out this strategic pivot. That's the message that turned the market sentiment around. The whole call felt like it was designed to shift focus.
It absolutely did. The central theme, the thing that clearly resonated, was the CEO calling this fiscal year, FY26, a year of stabilization.
A year of stabilization. Okay.
That phrase seemed to successfully anchor expectations away from the Q1 disaster and towards, future efficiency, a path back to profit. And they didn't just offer vague promises. They laid out a pretty concrete restructuring plan. That's what the market latched onto.
So what are the concrete parts of that plan? What are the numbers?
Well, the headline grabber is the cost savings target. They're aiming for an additional $50 million in gross cost savings over the next 2 years.
50 million. That's a big number for a company this size.
It is. And crucially, they stressed this is on top of the $17 million in annualized savings they already booked in FY25. So you layer that $50 million on top.
Right, the $17 million they already found.
Exactly. So when you think about the company's current market value, that $50 million in potential savings becomes a really significant lever. It could directly boost the company's overall value if they pull it off.
Okay, so $50 million in cost cuts. But where's that coming from? Is it just trimming fat, or are they cutting into muscle, like growth investments?
They're positioning it as operational efficiency. Things like streamlining how they source products, making manufacturing more efficient, optimizing distribution, that kind of thing.
Got it. So efficiency gains, but there is also a big personnel change announced, right?
Yes, and that was arguably just as important as the cost number. They highlighted the hiring of Melanie Babcock as their new Chief Marketing and Growth Officer, or CMGO.
Melanie Babcock. Her background is interesting. She came from Home Depot, leading their retail media efforts, right?
That's right. And that's not a random hire. It's highly strategic. Her mandate is basically a complete rebuild of their marketing. The idea is to implement a data-driven, full-funnel approach.
Full funnel marketing. What does that mean practically for them?
Well, the thinking seems to be that their old marketing structure was maybe inefficient, probably relied too much on just buying customers through expensive channels. Bringing in someone with that sophisticated retail media background signals a shift towards efficiency and likely better monetization of their existing customer base and website traffic.
Okay, so maybe using their own website traffic more like an ad platform like Home Depot does, or is it broader?
I think it's broader, but the core idea is similar. Ruthless efficiency, getting more value from the customers they already have or attract. And the key financial innovation tied to this is shifting their internal focus to what they call a marketing contribution margin framework.
Marketing contribution margin. Okay, that sounds specific. How is that different from the gross margin we talked about earlier? Why is that metric such a big deal for them now?
That's a great question because it's crucial. Gross margin, as you know, is just revenue minus the direct cost of goods sold. Pretty simple.
Right.
Marketing contribution margin goes deeper. You take that gross profit, and then you subtract all the variable marketing costs tied specifically to getting that customer and fulfilling that order. Think digital ad spend, promotions, maybe some fulfillment costs directly tied to marketing efforts.
Ah, okay. So it isolates the profitability after the cost of acquiring the customer.
Exactly. By focusing on that margin, FLWS is saying they're no longer just chasing overall revenue growth at any cost. They're optimizing for the profit they make on each transaction after paying for all that expensive digital advertising.
So improving that specific margin could significantly lift overall profitability, even if total sales don't grow much or even shrink a bit, because they're focusing on quality revenue.
That's precisely the idea. It signals a shift towards prioritizing profitable growth over just volume.
And presumably, part of improving those unit economics involves finding cheaper ways to reach customers, not just relying on their own website.
Exactly right. They talked quite a bit about leveraging new channels. They're pushing more aggressively into third-party marketplaces, think Amazon, Walmart, the big ones.
Okay, selling through other platforms.
Yeah, and also testing things like seasonal holiday pop-up shops. It's a clear effort to broaden their reach and, importantly, reduce their dependence on driving all traffic to their own websites, which involves those constantly rising, super expensive search engine marketing bids.
Right, trying to lower that customer acquisition cost. Okay, so let's put this whole call in context. Why did the market, after seeing such rough Q1 numbers, suddenly give this management team the benefit of the doubt on this turnaround story?
Well, you have to remember just how beaten down this stock was before the call. FLWS shares were down roughly 22% in the month leading up to it. And over the past year, down a brutal 56%.
Wow, 56% down in a year. massively underperforming.
Hugely underperforming retail ETF like XRT, small cap indices like IWM. The stock price basically reflected that the market had already written them off, pricing them like a legacy brand in slow terminal decline.
So expectations were just incredibly low.
Exactly. The bar was on the floor, which means any credible turnaround story, especially one with a big tangible number like $50 million in savings attached to it, had the potential to cause an outsized positive reaction.
Okay, that makes sense. So given investors bought the story on October 30th, what do they need to see now? What are the key metrics and catalysts everyone will be watching over the next, say, 1 or 2 quarters? They need proof.
Absolutely. Credibility now hinges entirely on execution, especially through the critical Q2 holiday season. So, number 1, evidence of improved marketing contribution margins. Are they actually making more profit per order under this new framework?
Okay, show us the margin improvement.
Number 2, real progress on those third-party marketplaces. Are they actually selling meaningful volume through Amazon and Walmart? Is it profitable volume? Or are they just listing products there?
Got it. Marketplace traction.
And third, updates on that cost-saving plan. Is it on track? The market will be looking very closely for management to potentially offer some actual numerical financial guidance in the next update. That would signal real confidence.
So the overall feeling must still be pretty cautious then. This sounds like a highly speculative bet on a turnaround narrative. It's completely execution dependent. That $50 million savings target, that's a strong lever, something they largely control. But you can't just ignore the reality of the Q1 results. The top-line pressure, the shrinking margins, the whole turnaround really hangs on whether they can execute flawlessly right through the holidays. If volumes disappoint again, or if the new CMO strategy doesn't quickly improve those unit economics, well, that credibility they just bought could vanish fast.
All right, let's shift gears now to our not financial advice segment. Just a reminder, this is purely conceptual, a way to think strategically about the situation. We're going to sketch out an outrageous but plausible trade idea based on this deep value turnaround theme we've been discussing. Okay, let's put on the hypothetical trader hat for a minute. The core thesis here is all about inflection. The market, as we said, is pricing FLWS like it's slowly dying, hence that massive underperformance. But the turnaround pitch combines 2 powerful elements. First, that tangible $50 million in gross cost savings, which is a really chunky number relative to their current enterprise value. And second, the hiring of a modern strategic CMO like Babcock, who's laser-focused on fixing the unit economics. The argument is the market might be totally missing a high-probability inflection point here.
Okay, so if you believe that inflection point is real, how would you structure a trade to capture that potential upside, given the high risk and volatility? An aggressive long position sounds right, but maybe needs some finesse.
Right. You'd want leverage, but also defined risk. So one way to implement an aggressive long FLWS position could be using options, specifically maybe short-dated deep-in-the-money call options.
Deep-in-the-money calls.
Yeah.
Why those?
Because they give you significant exposure to the stock's movement, similar to owning the shares, but with a lower capital outlay and a strictly defined maximum loss, the premium you paid for the options.
Yeah.
It maximizes leverage if the story works, while capping the downside if it doesn't.
Okay, leveraged upside, cap downside. But the whole retail sector is shaky. How would you potentially hedge that broader market risk or even help finance the cost of those options?
That's where a pairs trade comes in. To potentially finance the long FLWS calls and hedge against general retail weakness, you could initiate a short position against a broader retail ETF, like XRT, or maybe a specific peer that doesn't have such a clear, catalyst-driven turnaround story.
So short XRT, long FLWS via options. What's the logic there?
The idea is if the whole retail sector does well, both might go up, but FLWS should, in theory, outperform significantly because of its specific turnaround catalysts, cost cuts, marketing fix. If the retail sector weakens, your short XRT position helps cushion the potential losses on the long FLWS leg. You're betting on FLWS's relative outperformance.
Makes sense. So what's the target for this hypothetical trade? What needs to happen for it to work and what kills it?
The target would be ambitious, reflecting the turnaround potential. Maybe projecting, say, a 50% move up in the stock price over the next 3 quarters.
50%. What gets you there?
2 key things need to be confirmed. First, clear, measurable progress on hitting at least the first half of that $50 million savings target. Second, real evidence in the Q2 results that the marketplace strategy is gaining traction and, crucially, that the new marketing contribution margin focus is actually improving unit economics.
And the major risk?
The risk is simple: execution failure. If holiday volumes are weak again, or if the new marketing framework doesn't deliver better customer lifetime value quickly, the market's initial pessimism gets validated, and the stock could easily fall further. The reward hinges on that perception shifting from dying retail to smart, efficient omnichannel restructuring.
Okay, so wrapping this up. The big takeaway here seems to be a major headline miss on the numbers, completely overshadowed by a really compelling turnaround story, focused on $50 million in extra savings, and a whole new marketing approach targeting unit economics.
Exactly. And the provocative thought maybe to leave you with is this. Given how volatile the stock has been, how low the share price got, you have to ask, is the current market valuation giving any credit whatsoever to the potential upside here? I mean, what happens if this new chief marketing officer actually succeeds? If she brings that retail media savvy from Home Depot and fundamentally fixes how they find and keep profitable customers? Fundamentally fixes that customer lifetime value equation. If they solve for CLV, this becomes a completely different story, almost regardless of minor bumps in quarterly revenue. Is any of that potential priced in right now?
Something definitely to think about. That's all for this deep dive. We encourage you to dig into these ideas further. Thanks for joining us, and we'll catch you next time.